This is the best piece of advice I've ever heard about investing. It came from a millionaire I looked up to as a kid. After overhearing him talk about investing, I wanted to get involved, but as a complete beginner, I didn't know where to start. So I asked him, how do I pick the right stocks to invest in? His answer was very simple. Treat it like finding a girlfriend. This is quite a clever way to look at it because when you buy a share in a company, you actually become a part owner. This is like a partnership between you and the company. And just like a relationship, you want to make sure it's happy, long, and successful. But look, I'm not going to pretend that there's a crystal ball that can tell you when to buy a stock before it rockets in value like most of the fake gurus online. However, there are certainly a few things you can do to tip the odds in your favor. When you're looking for a partner, you need to have a strategy in mind. Are you going to shower them with gifts like a simp or treat them mean to keep them keen? You'll get very different results depending on which strategy you choose, and the same goes for stocks. So just like dating, you need to figure out how you're going to approach the stock market so that you get the results you want. There are two strategies you can choose from, the technical or the fundamental approach. Both of these options are very different, so let's quickly go over what they involve. Technical analysis is mainly for short-term day traders. They use charts and price action to identify patterns that supposedly help them predict if a stock is going to go up or down in the short term. I use the word supposedly because in my opinion, most of the people using this strategy are glorified gamblers. Is it possible to day trade successfully? Yes, but more than 95% of day traders lose money rather than making it, according to the Motley Fool. Fundamental analysis is like being a detective for a company. You look at everything, from their financial reports to how well known the brand is and who's running the show. All these pieces of information help you understand how the company is doing now and how it might perform in the future. This approach can help you pick a range of stocks that can make you a nice amount of money over a 3 to 10 year period. I know saying this will probably ruin my watch time, but I only want people getting into this for the right reasons. So if you're looking for a way to get rich quick, then stop watching my video now. My goal is to secure your financial future, not just help you make a quick buck. Also remember, with any kind of investing, your money can go down as well as up. If you're still with me, then comment down below, I'm in, so I know how many of you are willing to invest for the long term. Right, all done? Cool, let's jump into... When you're on a dating app and checking out someone's profile, you usually look at their pictures and read their bio to see if they'd make a good match. It's exactly the same when you're thinking about investing in a company. You have to check out the company's profile, which in this case is something called a balance sheet. A balance sheet is a financial statement that provides a snapshot of a company's financial position at a specific point in time. It details the company's assets, liabilities, and shareholders' equity. Don't worry if that sounds a bit confusing. We'll take a look at one together and I'll break it down with you. I'm going to be using Trading 212 to do this, which is a great place to research and buy stocks. You're welcome to download it and follow along. Trading 212 is also sponsoring this portion of the video, and if you use the code Tilbury, you'll also get a free fractional share worth up to £100 when you open your account. I'll put the link in the description. Plus you can get more free stocks by inviting your friends. Both of you will get a free share as long as they fund their account. I'm going to be using their desktop website for this video, but you can do all of this on the mobile app if you want to. For everyone in the USA, you can find the same information on Yahoo Finance. Remember that nothing in this video should be taken as financial advice. I'm not a financial advisor, and when investing, your capital is at risk. So to find the balance sheet, just head to the stock you're interested in. For this example, I'm going to pick Coca-Cola. Scroll down the page, click on the financials and then the balance sheet and more financials. This pulls up a pretty complicated looking page, but trust me, it is actually very simple. To help you understand this balance sheet, think of it like a cookie jar. There you go. At the top, you've got the current assets. These are like the cookies you can grab and eat. Very nice. For a company, this is the cash, or anything that can be turned into cash within 12 months. Next, you have the longer term assets. These are like the cookies that are deeper down in the jar. For a company, this often includes the headquarters and equipment. Here you have the intangible assets. These are like the invisible things that make the cookies taste good. You can't touch these things, but they bring a lot of value. For a company, this is patents, intellectual property, trademarks, and goodwill. This next section is all about liabilities. These are like the cookies that you've promised to your friends for borrowing their ingredients. I'm most interested in the current liabilities, as these will need to be paid back within 1 year or a normal operating cycle. So now you know what all of this information means. What should you actually do with it? Well, there's a simple calculation you can do to easily know if a company is high risk or not, and that is total current assets divided by total current liabilities. A good rule of thumb is this number should be above 1. But how does this actually work in practice? Well, let's put Coca-Cola's numbers in. Their total current assets are $26.73 billion. So if we divide that by their total current liabilities, which are $23.57 billion, that comes to approximately 1.13. This means the company has $1.3 in current assets for every $1 in current liabilities, indicating they have enough short-term assets to cover their short-term debts. This is a great indicator, but our work is far from over. When you're getting to know someone new, you're probably curious about their past relationships. It's like doing a bit of a background check, right? You might wonder whether they've ever cheated or how many partners they've had. It's pretty much the same when you're considering investing. Before you put your hard-earned cash into a company, you want to check out its track record. That's where the income statement comes in. And unlike people, public companies have to be upfront and honest about their past. An income statement is like a report card for a company, showing how well it did over a specific period, like a month, a quarter, or a year. Put simply, it tells you how much money the company made and how much it spent. This is normally found in the same place as the balance sheet. If you're using the Trading 212 app like me, then just click on the first tab and then you'll see all the information. Here at the top, we have the total revenue, which is the total the business took in the time period. As we can see from Coca-Cola, they took $45.75 billion in 2023, which isn't too shabby. If we scroll down a bit, we get to the net income, which is the money the company makes after all expenses have been deducted. For Coca-Cola, this is $10.71 billion. So, why does this matter? Well, every business has two main types of expenses, the cost of revenue and the cost of operations. If either of these are too high, then it could be a red flag. Just think about it. If you were selling custom t-shirts, you'd have to spend money on fabric and printing. This is your cost of revenue, as you can't create custom t-shirts without these materials, so this is a necessary expense. But that's not it. You'd also have to spend money on marketing and potentially staff. These are known as your operating expenses. Once you subtract both the cost of revenue and the operating expenses from the total money you make from selling your custom t-shirts, you get your operating income. Now, if you just scale up that example, it's the same idea for big companies like Coca-Cola. See here, this is the operating income. So now you know what all this information means. What should you actually do with it? Well, here's a simple calculation to see if a business is making a healthy amount of profit. Operating income divided by total revenue times 100. According to Tide Banking, as a rule of thumb, 5% is a low profit margin, 10% is a healthy margin, and 20% is a high margin. If we plug Coca-Cola's numbers into this calculation, we get approximately 25.73%, which is a high profit margin. This is a great indicator to use. However, it's important to remember that older, more established companies will be more profitable than newer, faster growing companies. So profitability isn't the most important thing. I mean, Amazon took years to make a profit and look at them now. But saying this, you should also keep in mind that a company that's done well in the past doesn't mean that it will continue to do well in the future. Past performance doesn't guarantee future results. Listen, it might not sound like a romantic thing to say,